Have you watched it yesterday's episode? Not yet? Then do watch it right now so that you can start with day 2 prep with me. Okay, guys, welcome. So today is the second day of our CFA prep and we are going to now dive into more into the mathematical aspect of the portfolio risk and return. So without any further delay, let's start. So again, like the day one, I have basically list down few questions which we will go through in today's session, and we will take one more video for this to dive into more graphical aspect of it and to increase your understanding of the overall concept. So let's get right to it. So these are the basic questions which I have listed down for today. So it's going to be a small video, but it's gonna be interesting. So first of all, whatever when we were discussing yesterday that you have to invest in multiple asset classes to diversify the things, and there's a certain risk associated with each of the type of asset classes. So what exactly, how do we quantify that, how do we understand the returns and the risks? So let's get into it. So the first question is, what is the holding period return? Suppose the for example uh, you have done an investment, and that holds a particular value. Let's say you can think of as a bond, and then there's an initial value, and then uh, you over a period of time when you were holding, you get certain dividends of it, and then finally at the end there's an ending value. So you want to understand what's the overall return from this bond or from the asset class. The calculation would be very easy, and that is basically out of intuition. You take the ending value, you subtract the initial value, so you know that okay, how much it has increased or decreased. Then you, during the time when you have been holding this, you add the income from that asset class, and that divide that entire thing by the initial value. So it is relative to the initial value, how much increase or the decrease in the percentage of the value which has happened for you, and that will be the return for you for that investment in that asset class. So I can quickly show you the formula as well. So what I mean is, holding period return would be final value minus initial value plus any asset income divided by the initial value. Okay, so we can take examples also later, maybe in the next video, but for now we'll continue ahead. So okay, so what are the different ways to measure the return? So okay, now we are saying that okay, there's a holding period return, and this, let's say this is the return percentage. So what are the different ways, and how do we quantify a return in case there are for multiple periods? So one basic concept is arithmetic average. For example, you have as a class which gives you certain xyz percentage of return in 3 years. Then you say okay, the for the I will just sum it up and average by 3. So x plus y plus z by 3 will give you the average return. Now, what are the other types of return? So there's a geometric return as well. Now think of it like this. So consider this example. Why is sometimes we don't find the arithmetic return good? Because think of it like, I have a 1 rupee, you invested this 1 rupee, and the next year it became 3 rupees. So there's a 200% increase. Okay, then the following year it became, let's say again to 1.5. That's a 50% decrease, right? So or and again let's say there's a decrease, and it became back to 1 rupee. Now if you do the calculation, you will see that the number, the percentage which you get, and if you sum it up and just divide by 3, because we are not actually seeing the order and the money which is there, and in what order we are getting the loss or the gain. So what will happen is that even the overall average you will see as a positive, but it doesn't make sense because your money didn't change from 1 even in 3 years. So ideally it should have been 0 for the average of 3 years, but it will still give you the some value. And so that's why people generally try to calculate in terms of geometric average. Geometric averages is like you take the geometric mean of those returns. So for example, there's a 20%, there's an x 20%, then there's a 10% decrease. So you say 1.2 into 1.2 into 0.9 and raised to power 1 by 3 minus 1, and then that would be your return for the 3 years. So that's how you calculate. Now even in the geometric return, you don't follow the order. I mean, had the 10% decrease happened in the first year, you will still end up the same value for the 3 years. But that's where it doesn't give a perfect picture to the investor. So what they even tend to go is the money weighted return, where it is nothing but an IR calculation. The way you have these cash flow problems, where you want to check that, okay, what would be the ideal internal rate of return for this cash flow. That is ideally how you are basically calculating this money weighted return for an asset class, and that gives you more better picture, because you are taking into the consideration when the flow went in or out during the time span of the investment. So that is the different ways on how do we measure the returns. And I'll share a link in which I'll put down all the formulas and everything, but I want you to understand it intuitively, why we are having different kinds of return and why we are preferring one over the other. Okay, so that goes down, and there are other types of return measures as well. Like you can basically have an annualized return. So if you see like a return which has been put for 3 years, if you want to just take down for each year, then you take like 1/3 of it and then -1. So there's a lot of calculation, but the idea is you want to portray on a yearly basis how your investment is performing. Okay, and now what are the other mathematical terms we will end up in this analysis? So that's where the third question comes. So what is the mean, median, mode, skewness, and kurtosis? So okay, so for example, mean is nothing but if let's say you have like returns over the 5 periods, and then you simply take the mean of it, average of it, and then there you have the mean return. Okay, so this is simple average. Median, if you have learned in mathematics, if let's say you have like five numbers, and then you want to find median, you just arrange them in increasing order, and the middle number will be the median. Or in case you have even numbers, then you don't have anything as a middle number. There will be two numbers which will be on the n/2 position. It's a fraction, so there will be a left and right to it. You just take the average of it, called the median. And mode is just the number which occurs with the highest frequency. So how exactly this helps in the asset classes risk and return? So ideally, if let's say asset class have a normal distribution, which is like a normal bell-shaped curve, mean will be equal to the mode will be equal to the median, and you don't have any issues. But what if let's say there is some skewness? That's where we understand what is skewness. So skewness is just, let's say you take a normal bell-shaped curve and you try to put the mean onto a left hand side or a right hand side. So the way on which the tail, so let me try to show you with a graph that will be more easy. So I say this is the normal x-axis. The normal bell-shaped curve will look like this. Okay, now understand this clearly, because this is interesting. I'm going to show you our positive skewness. Remember, positive skewness would mean the peak will be on the negative side. That's what one thing you can keep in your head, so that you don't miss out on the notation. So this is positive skewness. Remember, the peak is on the left hand side. So the same way, if there's a negative skewness, the peak will be on the right side. How does and how we can make interpretation about these? So let me as well. Very nice. Okay, so okay, so I hope you get the picture now. The idea is, think of it, for example, a lottery. Like what happens in a lottery? Very There's a very less probability that you will be winning very high, right? So most of the times you will be losing. So this is the case of a lottery, right? Because most of the times this is the highest probability of this much loss. Most of the times you will be incurring the loss of a small amount, because the lottery ticket doesn't cost that much. But there's a very less probability that you might end up winning a very high profit, right? So this is what the case of a lottery. Now, what about the negative skewness? Negative skewness, you can think of it like an insurance, right? So most of the times you will be having a probability that you will end up in profit because you can gain from the insurance, whereas there's a very less probability that you might incur a big loss. So for think of an example that you kept given on premium but you never used it, so that's very less probability because one way or the other you might be using it someday. So that's the case of insurance. So always just remember these two cases and you will never forget this concept of the skewness. Now, what is kurtosis? Kurtosis is again like a term to say that okay, in these extreme outliers which you see, what is the probability? So is the probability too high or is the probability too low? So for example, if let's say the tails, which we call these as the tails, if the tails are fatter, uh, that is like the outliers probability is quite high, and that's when you see the fatter tails and high peaked. So this is the how we define kurtosis. We might not be able to interpret it that clearly, but think of it like an investment where the extreme outcomes have even higher probabilities. Like for example, in lottery, where we saw that okay, the probability of getting a very high profit is very low. Think of it some scenario where it's still like even the extreme outcomes have a significant probability, right? So that basically increases the risk. So now we go back to our question. What is the skewness? What is kurtosis? Okay, we all have all answered that. Now, so generally when we define an asset class, we generally try to define in terms of mean, which is its return, and the risk. Now, what exactly is the risk? Have we identified in all these in any of these five parameters? No, we identify it with something called a standard deviation. How is the standard deviation calculated? Standard deviation is basically a statistical concept which is basically the square root of the variance. Now, what is variance? Variance is the expected value of the square deviation from the mean. So think of it like this: you have like five returns, you took an average, then you see that okay, how much each return differed from the average. You took the squares and then you like took their average, and then you take the under root. That will give you the standard deviation. Okay, now so that's the two parameters where we generally see like what is the return and what is the risk. So return will be your like mean return or however you are calculating, and then the risk will be different defined by the standard deviation for that asset class. Okay, now so that is how we calculate the risk mathematically. Okay, so the more the standard deviation, the higher so it is expected generally that the higher returns you will get at higher risk, which means a higher standard deviation. So now that will be that basically decides a lot of factors where we want to invest, like whether we want to invest in certain asset classes where the risk is too high but the returns are also too high. So that depends on our investment nature, that how much risk lovers are we, or how much risk aversion we want to do. So we'll go into that also, like how do we find out the optimal portfolio, how do we maximize our returns keeping a particular risk, and with all the fancy graphs and everything, which will become very interesting in the next session. But here I'll just cover up one small concept also, which is the covariance. So think of it like this, that you're not going to be in a situation where there's only one asset class. We have said that okay, you want to basically invest in diversified asset classes, right? So how one asset class relates to the other asset class is what covariance is. For example, if you invest in real estate versus you invest in commodities, is there a relation? Like if let's say real estate goes up, does commodity go up? Or just giving an example, is there a relation between it? Is the one thing can go up, the other can go down? So this is what is covariance. Now, a very small point which is very interesting. Although we say that if you diversify, the overall risk goes down, and we will see in the calculation how exactly what we mean in the next lecture. So do watch the next lecture very carefully, because will be a very nice and fine maths and we will be able to prove very nice things. But remember here, it's not always that So it is said that if they are not perfectly correlated, then the diversification helps. And why is that if we are perfectly correlated, the diversification won't help? Perfectly correlated means what? First answer, understand that. Let's say if something goes up by 10%, the other also goes by 10%. This has this much risk, the other thing is also that much risk. Now, these two are different, but think of it like I had like 100 million and I wanted to invest in one. But now, okay, I thought, okay, maybe just investing in one, because Prashant said that, oh, investing in one will be like a loss. So I have these two and I'll invest half in these two. Oh man, still the risk is same. What we learned now, because they are perfectly correlated, and when you will see the maths of it, the risk will turn out to be exactly the same. It doesn't go down. So the, the multiple assets which we are investing into should not be exactly perfectly correlated. So what is the coefficient of correlation and everything we will be covering in the next video, because that will be quite mathematical, plus a lot of fancy graphs which will clear you all the understanding on how an investor decides on what is the optimal portfolio for it and how to invest into it. So that will be our next lecture, and stay tuned with me, guys. If you're liking how we are going ahead with the prep, do subscribe the channel, hit the like buttons, share with your friends, and do let me know any feedback in the comments. And please watch it full, because there's a lot of learning in this. Goodbye, guys, till then. Bye bye.